Hello students, today we are going to learn meaning of double entry system. According to this system, every business transaction affects at least two accounts in opposite directions. For example, if the furniture is purchased in the business, furniture is increased whereas cash is decreased. There can be no transaction in the business which affects. As such, both the aspects of every transaction are recorded under this system. It may, however, be noted that the double entry does not mean that a transaction is recorded twice, but it means that at least two accounts are affected by a transaction. One account receiving a benefit and the other account who gives something to the business is credited. The amount of every transaction is written twice, once as a debit and again as a credit. For example, we received rupees 20,000 from Mohan. The entry will be cash account Dr 20,000 to Mohan 20,000, being rupees 20,000 received from Mohan. Double entry system is like a weigh balance. Its both side is always equal to each other. You can see the picture. Debit side is rupees 1,000 and the credit side is rupees 1,000. It will be never like that debit side is rupees 1,000 and credit side is 5,000, or it will be never like that credit is 5,000 and debit is 10,000. If debit is 1,000, then credit will always be 1,000. Means both debit and credit will be equal to each other like a weigh balance. Now let us come to the golden rules of accounting. There are three accounts: personal account, real accounts and nominal accounts. And the rule which comes under this is, in personal account, debit the receiver and credit the giver. In real accounts, debit what comes in and credit what goes out. In nominal accounts, debit the expenses and losses and credit incomes and gains. Personal account. Let us come to this. The accounts which relate to an individual, firm, company or an institution are called personal accounts. Accounts of Mohan, accounts of Ramchandar, Krishan Chandar, accounts of DCM Limited, accounts of Delhi University, bank account, capital account of the proprietor, etc. are examples of personal accounts. Personal account, the rule for this is debit the receiver and credit the giver. In other words, debit that person's account who receives something from the business and credit that person's account who gives something to the business. Now let us understand this by an example. Like in example 1, paid rupees 10,000 to Hari. In this case, two accounts affected are Hari's account and cash account. According to the rule of debit the receiver, Hari's account will be debited in the entry as he is the receiver of the cash. Simultaneously, the account of cash will be credited as cash has gone out. The entry for this will be Hari debit the receiver Dr rupees 10,000 to cash account 10,000, being rupees 10,000 paid to Hari. Now let us understand it by the another example. Received rupees 5,000 from Mohan. In this case, cash account will be debited as cash has been received and Mohan's account will be credited according to the rule of credit the giver. The entry will be cash account Dr 5,000 to Mohan, credit the giver 5,000, being received rupees 5,000 from Mohan. Students, you can notice why I am giving the example of Mohan and Hari. Why I am giving the example of this? Because I am explaining you this because it is a personal account and personal account relate to an individual, firm and company. So I am explaining it with you by the help of me. Now, what is the object of personal account? The object of preparing a personal account is to ascertain as to how much amount a personal account owes to the business, that is, how much amount is due to be received from him, and how much amount is owed to a personal account from the business, that is, how much amount is payable to him. The object means how much amount an individual has to pay to the business and how much amount a business will pay to the individual. Now let us come to the real account. The account of all those things whose value can be measured in terms of money and which are the properties of the business are termed as real accounts, such as cash account, furniture account, machinery account, goodwill account, etc. Let us come to the rule: debit what comes in and credit what goes out. According to this rule, whenever any property comes into the business, it is debited, and when it goes outside the business, it is credited. For example, if furniture for ₹5,000 has been purchased for cash, furniture account should be debited according to the rule of debit what comes in, while cash account should be credited according to the rule of credit what goes out. The entry for this will be furniture account, debit what comes in, Dr. 5,000, to cash account, credit what goes out, ₹5,000. Being furniture purchased for cash. The object for this is these accounts represent the value of various properties owned by a business in terms of money and indicate the financial position of the business. Now let us come to the nominal account. These accounts include the accounts of all expenses and incomes. The example of nominal accounts relating to expenses are salaries paid, rent paid, discount allowed, bad debts, etc. The examples of nominal accounts relating to income are commission received, interest received, discount received, etc. The rule for this is debit the expenses and losses and credit incomes and gains. Example: paid ₹5,000 for salaries. In this case, the two accounts being affected are salaries account and cash account. Salaries represent expenses, and as such, salaries account will be debited according to the rule of debit the expenses. On the other hand, cash account will be credited according to the rule of credit what goes out. So the entry will be salary account debit the expenses, Dr. 5,000, to cash account credit what goes out, 5,000. Now let us understand it by the another example. Received ₹1,000 for commission. In this case, the two accounts being affected are commission account and cash account. Commission account is a nominal account and represents an income. As such, commission account will be credited according to the rule of credit the incomes. Cash account is a real and as is coming in, therefore cash account will be debited according to the rule of debit what comes in. Entry will be cash account debit what comes in, Dr. 1,000, to commission account credit the incomes, 1,000. Being received ₹1,000 as commission. Now the object for preparing the nominal account are: nominal accounts are those accounts which are in name only and which do not really exist. These accounts are opened simply to explain the nature of head for which cash has been paid. In the absence of nominal account, it will be very difficult for the management to know the amount paid. Separately, on account of salary, rent, commission, etc. As such, the nominal account provide information regarding the following: amount is spent on various heads in a particular period, income received on various heads in a particular period. Now students, I have made a chart for you to understand the three golden rules of account. Debit: in personal account, debit the receiver, credit the giver. In real account, debit what comes in, credit what goes out. In nominal account, debit expenses and losses, credit incomes and gains. This chart will be very helpful for you to learn all the golden rules of accountancy. Students,